Well, folks, we have a market that is very interesting right now. S&P 500 down 0.6% here today. Nasdaq down about 1.5%. Seems like nothing crazy, right? Like, okay, down day, nothing crazy. Oh boy, we had stocks getting obliterated out there today. Palantir stock was down over 9 percentage points here today. An absolute obliteration of Palantir. Hims stock was all the way down to 42 bucks. It closed at here today, down 6.5%. Duolingo, the small dingo, look at this one, down 7.7% here today. It lost most of its yesterday gains. Cava, you got to be flipping my flapjacks or flipping a pita right on the floor. Oh my gosh, 68 bucks here today. That is a new low for Cava in the past year. That stock down about another 2% here today. That one just continues to get hammered. Coinbase stock, this one down almost 6% here today. Robinhood stock down over 6.5% here today. And this is off of just S&P 500 down, 0.6% or whatever. Unbelievable. So at the beginning of this video, this reaction video today, I want to talk about these stocks, each of them, like what's going on with them, okay? Then I'm going to give a little life advice out there after that, okay? From there, I want to go ahead and react to a few videos. I want to react to Mike Wilson. Mike Wilson was such a bear going into 23, such a bear going into 24. Oh my gosh. And now this man's out here going to CNBC talking about stocks are at the beginning of a new bull market. This is unbelievable, okay? I'm looking forward to react to that one, sharing my opinions and perspectives there. Mega cap tech is under-owned, says Morgan Stanley. What? Under-owned? That's an interesting, we're going to hear what they have to say in regards to that. And then the halftime investment committee, Josh Brown, JB, all those folks, kind of sharing their opinions on what the Fed's about to do, Jackson Hole, all those sorts of things. Hey, Reaction Channel, I appreciate you being here. Appreciate you sticking with me. I apologize for not posting on here last week. I couldn't post anything on this channel like last week, so I tried to reach out to YouTube. They weren't much help, but the moral of the story is we're back on the Reaction Channel, so I appreciate each and every one of you for being here. All I need from you is one smash of the like button. If you could just hit that like button for me, that would mean the world. All we need is 10%, at least 10% of people to hit the like button, and then we're doing well, okay? And I also want to give you guys something free here today. Pinned comment down there, I'll put my stock picking checklist. Okay, I can send that over via email or via text, however you want to receive it. My stock picking checklist, that's a great thing to look at before you ever buy a stock. It's, it's free. So I think you'll enjoy that. That is the pinned comment down there here today. Okay, alrighty, folks. So let's go ahead and let's have a little chat. Okay, listen, Palantir. This stock down 9+% here today. Okay, is there something broken with Palantir's business model? No, absolutely not. Business model is amazing. We all know that, okay? Is there something broken with the stock price? Maybe, but we don't have clarity on that yet either. The death of Palantir's stock price has also been greatly exaggerated many times. I mean, you could say this one's going in the coffin. Next thing you know, Palantir could slap you in the face and be at 200, okay? But do we have an issue with Palantir's valuation? The answer is absolutely yes. Palantir's valuation is out of control. I don't care whether you look at the trailing 12-month P, the forward P, the 2-year forward P. Look at the flipping flapjack and 3-year forward P. No, go ahead and look at the 5-year forward P. It's no matter which one you look at. Yeah, the stock's been trading very, very high recently. Okay, especially when the stock was touching 170s, 180s. Whew. Even at 157 is still very, very highly valued. Right, one of the most expensive stocks, not only in the stock market, but one of the most expensive stocks we've really seen in the history of the stock market for companies valued over $100 billion. Like, if I just think about all the companies that have ever been valued over $100 billion, there's a strong argument to be made that Palantir is the most insanely valued in the history of the stock market, okay? So that is something kind of taken into account here, but, I mean, the death of Palantir stock has been greatly exaggerated many, many times, but eventually Palantir is going to get smacked hard, and we're talking 50% downside, okay? Hims stock. This one, what's the deal with Hims? Is there a problem with the business? The answer is potentially. We don't know what, the government's been looking into Hims recently, right? That's a cloud over the stock, and that's been happening really for the past year. So we don't know what's going on there. We don't know what's going on with the weight loss supplements and those compounds and things like that. You can kind of game it out and try to make some justifications about, oh, this might happen or this might happen. But Hims is just kind of, we just don't know, and there's just a lot of cloudiness in regards to Hims' business model, what the numbers are actually going to be over the next few years and things like that. Okay, Is there a value? Is there a stock price problem? Well, yeah, there's a stock price problem because there's a worries about the fundamentals and where growth rates are going to be over the next few years. So that creates a stock price problem. Is there a valuation problem with HIMS? I don't think so. I don't think there's a valuation problem with HIMS, and that's where it differs a lot from Palantir. Palantir, you don't have any question about the business model. You don't really have any question about the stock price yet. You could, though. But with Palantir, there's a huge valuation problem. With HIMS, I don't think there's actually a valuation problem. So there's different. What Palantir is going through is different than what HIMS is going through, and that's important. Everybody understands that, okay? Duolingo, the small dingo, I'm going to save that one to talk about that one in the future, okay? Cava. Here's the deal with Cava. Do you have a fundamental issue with Cava? By the way, I ate Cava the other night with the family. It was good. I like Cava. We don't have any in Vegas yet, but I'm in Arizona right now at the exact moment, and yeah, we had one out here on the east side. It's good. I like Cava, and I've had it in New York City as well a few times. It's a good spot, okay? But here's the deal with Cava. Do we have a problem with the fundamentals of the business model? The answer is yes, we do. The company went from comp restaurant sales of 20% plus just a few quarters ago. In this latest quarter, they're at 2%. 2% when you're from 20-something? So it is an issue, actually, with the fundamentals of Cava in the short term. That does not mean it will remain like that. Maybe Cava will get right back on the right track, and comp restaurant sales will start increasing again in the back half of this year, next year, and, it's all going to be old news. But for the short term, you absolutely have an issue with the fundamentals of the business model. That also leads you into problems with the stock price. So we have a stock price problem as well because we have a fundamental problem. Lastly, it leads us into valuation. Do you have a valuation problem with Cava? Yes, we do. Because Cava, even at 68, still trades an extremely high forward P, 2-year forward P, especially if you're talking about 2% restaurant comp store sales. So you have a kind of a trifecta going against Cava right now, and that's why the stock has fallen so violently, despite the market not being that bad. I mean, Cava, it seems like just not that long ago, was $110, $120 stock. It's all the way down to 68, and yet the stock market's not very far from all-time highs. Now you got to think, where would Cava be if the market got hit 10, 15%? Probably $40, $30, something in there, right? Now, Coinbase, what's going on with Coinbase? That went down almost 6%. It's very simple, Coinbase. If there's any fear around momentum in Bitcoin and Ethereum, Coinbase is falling. Like, there's just no other way around that. If there's excitement around Bitcoin and Ethereum, Coinbase stock is going up. It's literally as simple as that. It's as simple as that. It's not more complicated. That's all there is to that story. Robinhood, 6.5%. Here's the deal with Hood, okay? Hood's benefited in a massive way, I would say, since Q4, okay? Since there started to become a lot of excitement around Trump being elected, and then he was elected, a lot of new retail investors got in the market who were not in the market during the Biden presidency. They felt excited, energized. Trump's in office, like they felt good, right? A lot of people didn't like Biden. A lot of people felt like, the stock market couldn't be good under him and things like that, right? And, if you didn't buy that 2022 dip, like, I don't know what to tell you, like, what a golden opportunity. That was literally a lifetime opportunity. The 2022 crash in tech stocks was a lifetime opportunity. You will not get it again. Even in the next stock market crash, you're not getting Meta at $88. I hate to break the news to you. You're not getting Netflix under 200. You're not getting Shopify at, what did Shopify fall to? I think Shopify fell like $25 in that crash. That's not happening again. Palantir at $5, $6 again. You think that's happening in the next crash? No, it's not. You will never, ever get those prices again on those great companies. That was a once-in-a-lifetime event, and people chose not to buy stocks because Biden was the president. Huge mistake. Like, don't ever let your politics dictate whether you invest in the stock market or not. It's a silly game. Ask anybody who's ever achieved any sort of meaningful wealth in this world, and every single one will tell you that. You don't want to invest because your guy or girl's not in office. Well, there hasn't been a girl in office yet, but because your guy's not in office, dude, you're going to miss out on so much money. I don't even know what to tell you. Like, you've got to be buying consistently in the market. And if you get a crash, I don't care if there's a crash under Trump, there's a crash under Biden, Kamala, Obama, Bush, you better be buying it, man. You better freaking be buying it. So, there's a lot of excitement. That's helped Hood's profits immensely. Let's just call it what it is. Like, you get a big influx of retail investors. Who's it helped more than anybody? It helps Robinhood. Robinhood's the most direct beneficiary of tons of new retail investors, traders getting in the market. And there's been a massive influx the last really like pretty much going on 9 months now at this point in time, right? Now, I think, this is my thought, there's going to be a major slowdown in terms of new investors getting in the market, likely starting in Q4. So you've had this like incredible 1 year, from Q4 last year to Q4 this year of just like new retail investors, traders getting in the market, boom, 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 right? A lot of excitement. I think that slowed down immensely, immensely. And I think we're going to get back to a normal cadence of people getting in the market, right? People just get interested, right? Sometimes they're 18, 19, like when I got in the market. Sometimes they're a lot older, right? And they just eventually get in the market. But you're going to go through a normal cadence starting in Q4 this year. And that's going to weigh on Robinhood's numbers immensely. Because Robinhood's not going to show those insane growth rates, in my opinion, in 2026, like they've been shown in 2025. You're going to see an extreme slowdown in that business model, essentially. And additionally, if you could go through a rough time in the market, simultaneously, that could create a dynamic where, potentially assets under management could even go down. Never mind if Bitcoin went down along with stocks, which is very, very possible, along with Ethereum, that could create a rough dynamic in the short term for Robinhood, right? But, you got to separate what's the long term with the short term. My thing with Robinhood is it's been a very impressive company. The way they turned around those financials is historic, in my opinion, over the last 3 years. Like, they've done an amazing job. With that being said, if what happens, like I think is going to happen with a major slowdown in retail traders and investors, their numbers are not going to look great in 2026. Doesn't mean it's going to be a disaster and like, oh, the stock's going to $10 or something like that. It's just you're going to have to deal with, much slower growth rates. Like, it's going to look pretty dang lame compared to 2025, at least in my opinion. And that's going to be something that has to go through. And what happens with Robinhood stock? Could the stock fall to $50 or $60? It's possible. You're getting everybody addicted to these massive growth rates that Robinhood's been showing this year in 2025. And then you get to next year when you don't get the massive influx of retail traders and investors, right? Never mind if, let's say, we had a rough Q4 this year. You had something similar to 2018. I can see a lot of people getting out of the market, right? I can see a lot of people that maybe have tested the market recently getting out. Because there's somebody that bought Palantir recently at 180. Imagine Palantir goes to 90. You think they're going to stay in the market? Most aren't, right? Somebody was buying HIMS. Didn't HIMS explode to like $60, $70 not that long ago? Like, let's take a peek at HIMS, okay? Let's take a peek at HIMS. I want to see this one. I think HIMS went to like $60 or $70 recently, didn't it? So here's a 1 year HIMS. Yeah, just very recently it was 66. Somebody bought HIMS at 66. Imagine HIMS goes to 33. Is that person staying in the market? I don't know. Like, they may be gone. They might be out, just to be quite frank with you. So, these are things to all factor in regards to Robinhood. It's very, very exciting growth rates and everything this year. But I've seen this game before. Do you need me to bring up an example? Listen, man, I'll bring up 2 examples, okay? 2018. Let me tell you what happened in 2018. 2018, market got really rough really quickly. SP 500 fell like 20+% quick. Like, I'm talking from like the fall started in like September, like the end of September from what I remember, and it ended I think it ended Christmas Eve, I want to say, or somewhere around there roughly, okay? And it was like 20% plus fall quick, right? And I lost like half the members of my private stock group at that particular time. People are like, of course I was newer on YouTube back then, right? So people didn't know if I was a real deal or whatnot, back then, right? But, a lot of people just left my private stock group because they thought like, oh, he doesn't know what he's talking about, or like, oh, market's not for me and those sorts of things, right? All for the market to come back extremely strong. And like 2019 was a banger year for me. Made so much money, it was ridiculous, right? And, people just didn't have the right mindset at that particular time. They didn't understand the game of the stock market, and like, when the stock market's down a lot, you better be buying heavy. You can't leave the market when it's down big. Like, that's when you need to be buying the heaviest. You lighten up your buys when the market starts to look overvalued, when the market's hitting new all-time high after new all-time high. You can lighten up your buys then. Like, people play the game in reverse. They go all in the market when it's like, on a 3-year blow off top bull run, and then they get to a crash and they're like, nah, I'm good. I don't want that. Like Meta at 88, no. Meta at 788, yeah, baby, I love Meta at 788. 88, no. Palantir at 6 in 2022, $6. No. But you know what? I'll pay 166 in 2025. That sounds good to me. Like, it's just crazy. It's crazy, man. Please don't ever be that person, okay? And if you need another example, I'll give you another example of how this business model can go south very quickly. I take you back to 2021, 2022. 2021, Robinhood's growth rates were incredible. You know why? We had a massive influx of retail investors get in the market in basically 2020 into the beginning of 2021. So Robinhood's growth rates were epic, unbelievable. Oh my gosh, everybody's trading stocks, investing in stocks, right? Then slowdown starts the very end of 2021, and then 2022, market gets ugly, right? 38% roughly the Nasdaq went down, peak to trough. Stocks wrecked all over the place. The biggest tech companies in the world, many of them the most powerful, down 50, 60. Nvidia stock fell 50%, 50, 60, 70, 80% downfalls for these stocks, right? Obliteration. Small caps tore up. Ugh. That happens. So just understand the game of the market, right? Understand a company like Robinhood's extraordinarily cyclical, like extremely cyclical. 1 minute that company can be showing ridiculous growth rates and you're like, oh my gosh, this company is going to grow to the moon and back. And it comes back from the moon and lands straight beneath the earth. I mean, it's incredible, right? So just understand that in regards to Hood there, okay? I might save my life-changing advice for the end of this video, okay? Let's go ahead and react to some videos up here.
U.S. equity strategist Mike Wilson. Mike, it's great to have you back on the program. A lot of people, they may have sold during the panic. They haven't been back in. They're waiting for an entry point. Is that coming?
Well, good afternoon, Brian. I mean, look, I don't know if they're going to get a big fat pitch like we got in April. That's probably very unlikely. We think ultimately that was the end of a pretty significant bear market. We're in the beginning of a new bear market. It's still about only 4 months into that. So,
a new bear market or bull market, Mike?
Actual.
He can't even say bull market because he was Mr. Bear for so long. He like bear market.
To be shallower than people want. I mean, that's the classic sign of a new bull market. It doesn't really let anybody in. The good news is, our data suggests that the retail investor really didn't sell in April. In fact, they were buyers all the way through that period. It was really more the institutional community that created that low and a lot of the passive strategies, quite frankly. And it was so quick that many people didn't even have time to react. So my suspicion is most of the viewers probably have plenty of equity exposure. They're probably enjoying the ride. The question they probably are asking themselves is, should I be selling here because I made so much money? And in that case, that's a personal decision. You got to pay taxes if you do that. My suspicion is if we get a pullback, it'll be probably less than 10%. Which in the grand scheme of things, that's not worth trying to trade around for most people.
So you believe we started a new bull market?
Listen, if you're wondering should you sell or not, let me show you exactly how you figure out if you need to sell or not. So here's a couple ways you can know whether you should sell a stock or not, okay? Listen, one way is you look at your company's trailing 12-month P, forward P, 2-year forward P, okay? Look at those compared to kind of where the market's trading at in general. You look at this on 1000xstocks.com, okay? We make it super simple for you. You can see where many stocks kind of trade out in the market, where that particular stock's trading at, right? So one, if your stock's trading massively over where many stocks are trading at, it might make sense to sell. But that is if you're in a situation where revenue growth, let's call it, is a lot lower than an average stock in the market. If you're talking about revenue growth that's much, much stronger than an average stock, right? Then it might make sense to hold that company unless it's so outrageously valued that you're like, okay, this is just ridiculous, right? Another way you want to do it on a higher level is you want to run your numbers, run your projections, okay? Use 1000xstocks.com, use a projections feature, and what are you expecting for revenue growth on average for a company over the next few years? Type those in, okay? Then the net income growth, type those in, right? Then what is a realistic P ratio for that particular stock? Type those in, right? If you don't even understand what I'm talking about right now and how all that stuff works, then you need to apply Jordan Private Stock Group, go through the course curriculums. You'll learn all that stuff on a high level and how stocks should be properly valued, revenue growth, net income growth, all those sorts of things, right? You run a bull case, you run a base case, you run a bear case, okay? If your base case is still giving you a really strong, let's call it double-digit compounding annual growth rate, it might make sense to hold that stock and not sell. If your compound annual growth rate on your base case is low, like 5% or something like that, right, over the coming years, might make sense to sell that stock. It's probably not worth being in, right? Because your bear case might come true as well. So that's the way to think about that on a higher level.
Back in April, why?
Because
that's how you think about it on a higher level, so you don't get into a situation where you're making decisions based on emotion, or I made a lot in this stock, so I'm selling. That's silliness. It's all about where that company's going over the next 3-5 years.
Market. I think that's the thing that people don't really acknowledge, which is that the sell-off in April was really a final capitulation to a bear market that began last summer. If you actually look at most stocks, they topped in July of 2024. They were down anywhere between 30 and 35% on average. I mean, that's a proper bear market that ended with a capitulatory price action. So whenever you get that type of price action, you have some demarcation between the bull market and the bear market. That was it. It was the capitulation. So, most bull markets don't last 4 months. They last, years, year or two at a minimum. So I think right now we're in buy the dip mode because we're in that bull market mentality. And the question now, and I think you were alluding to it earlier, is like, what should I own? And I think, we're probably getting to the stage of this.
So I fundamentally disagree with Mike Wilson here, okay? I believe we are coming upon a 3-year bull market. I do not take the March-April drop and call that a bear market. It was too short. It was too over, too fast. We're in a nearly 3-year bull market now, right? Market bottom October, right around October 2022, right? We're in mid-August of 2025. So we're coming up on nearly 3-year bull market now. Now, we've had small corrections along the way. We had the major correction in March, April. I don't consider that a bear market. Real bear market, man, you need the market to go down for many months in a row and just downtrend. Like 2022, proper bear market. Great example, right? Great financial crisis. Like true bear market. I would even call the drop at the end of 2018 a bear market, right? Because it started in September. It really didn't get over till the end of December. Even that I would call a bear market. Like, I feel like this drop we had this year wasn't a real bear market, in my opinion. That was just a severe correction we had. A severe short-term correction, boom, up to the other side. So, I think to, count us as a new bull market that started, April 9th when the market bottomed there, I think it's the wrong way to look at the market. I truly do. I don't believe in that at all. Mike Wilson.
Market where you can probably see some broadening out. Maybe that's one of the reasons why we're seeing the Mag 7 start to maybe underperform a bit now. And that's really going to be contingent, in my view, on when the Fed starts actually cutting interest rates. I don't know if they're going to do it in September or not. But once they start actually doing that, that's when you'll probably see the bull market really broaden out.
Yeah, I said it was kind of a weird market day. I posted that to X as well, and it kind of is because all Mag 7 are lower right now. The Palantirs, the AMDs, the stocks that have been red hot the last couple of months, they're the leading laggards. In other words, they're down the most, a percentage basis, on the Nasdaq 100 and mid caps, which have been pretty much, the Jan Brady's of the market, pretty much ignored Mike Wilson for a long time. They're actually slightly higher. One day does not a trend make. I get it. But does it feel like we're starting to see that broadening out a little bit?
Well, I think it's the beginning. Like, we got to remember, it's also August, Brian. I mean, it's very thinly traded right now. We have a big event this end of the week with the Jackson Hole conference, and we're waiting to see if they're going to give us any sign on timing for that first Fed cut, which is probably forthcoming sometime in the next 3 to 6 months. And what I would say is that we're in that bottoming process. We've been underweight small mid caps now for going on 4 years. Okay, and it's been the right view. And we're starting to see the small mid caps start to bottom out a little bit on a relative basis, in the sense that they're not going down at the same pace relative to the S&P 500. That's the beginnings of something, I think. But I don't think it's time yet to go fully all in. But it is time to be considering that move, given the 4 years of relative underperformance.
I'm not taking anything away from the importance and magnitude of this week's Jackson Hole conference, but I'm going to take a little bit away from the importance and magnitude of it. Here's why, Mike. We know that Jerome Powell is out, probably in May when his term is ending. I know May seems like it's a long way off. It's really not. There's only a few Fed meetings ahead. And we know this. I think it's fair to say, right? And if I'm wrong, correct me, Mike, that the next Fed chair is going to be somebody who is definitely prone to interest rate cuts, period, end of story. So at what point, maybe it's now, do you and your team already start to factor in rate cuts, because they are coming, whether it's in September or whether it's right after May?
Yeah, look, I mean, the stock market is absolutely already pricing in some of that. That's one of the reasons why the rally has been so relentless. And it's definitely been part of our view why we've been more bullish since May, because we do see that coming down the pike. However, for the true broadening out, what we need to see is the back end of the bond market really come down to get the interest rate sensitive parts of the market really moving and get some of the capital spending going, which is also going to be helped by the tax bill. So we're in that window. Nobody has a crystal ball. The small mid cap stocks have had a good absolute move. Okay. So that's one thing you have to keep in mind. It's not like they've been flat since April. They've gone up quite a bit too. They just haven't gone up as much. So if we're going to get a consolidation or some sort of correction in the third quarter as we've been expecting, then that's going to be the time when you sort of make the rotation. It's going to all happen at the same period, which is sometime probably the next 6 weeks.
Alrighty, next one up here, mega cap tech is underowned by the market.
Are the most underowned, at least amongst actively managed funds in more than 16 years. The gap between portfolio and S&P weightings widening significantly in the second quarter. Firm argues this could actually be a good thing for the sector. Joining me now to discuss, one of the analysts behind the note, Eric Woodring. Eric, I know you don't cover all these names. I think you do cover Apple, so why don't we start there? I can understand why, if you're running an actively managed portfolio, you don't want to own Apple. I mean, it's not growing its top line, or to be fair, last quarter was stronger. It doesn't have an AI strategy. It may still be under pressure from tariffs, although that doesn't appear to be the case. So, why is that an opportunity in your opinion?
Sure. Thank you for having me on, David. So, one thing, if we just take a big step back, most of the mega caps are generally underowned. If we think about their relative weighting in the S&P, which is the index that we base this analysis off of, these are very big stocks with very big weightings, and sometimes you get too concentrated if you own a number of these. So naturally, investors, active managers are underweight the mega caps, even the NVIDIAs of the world that have obviously had their amazing run. When we drill down on Apple, David, many of the points that you just made are correct. Top line growth has been relatively tepid. Apple is faced with a number of kind of either geopolitical or regulatory headwinds that they've had to work through. And so on a look back basis, again, the underweighting is clear. Why institutional investors would be there. Going forward, though, I just think the narrative feels a little bit different to me. And this is what we wrote about towards the end of last week, which is the combination of three things gets me to feel a bit better about the stock as I look out over the next 12 months. One is obviously dodging a major risk in Section 232 tariffs. That could have been up to 10% EPS downside. Instead, it's effectively a non-event. The second one, go back to earnings, and to your point, David, the core of the business, even when you normalize for pull forward or one-timers, was just better than we expected, both products and the services business, importantly. And then the third leg of this stool is, as we look out, we're getting a little bit more kind of breadcrumbs, so to speak, that there is some semblance of strategy for AI at Apple, meaning we're seeing a bit of a CapEx uptick. It's not significant, but it's moving in the right direction. You hear the Tim from Apple. To me, his tone today is very different than 3 or 6 months ago. And then you get reporting that Apple is potentially, working on their own second generation of AI technology,
right?
Partnered with the potential of partnering. Yep. So it just makes you feel a little bit better on a look forward basis.
I get it. And we'll all see if we ever do get that deal that many speculate, although who knows. When it comes to this broader theme, though, in terms of actively managed portfolio.
Do I think big tech is underowned? Listen, I can answer a question like that, okay? you can always come back to math. Okay, does the math make sense or not? Right, the math's going to tell you if stocks are underowned or overowned. Right, so let's pull up some big techs here. Okay, let's pull up Meta, Google, McDougal, and let's go Apple to start here. Okay, so let's go ahead and let's go. I think Microsoft, Mr. Softy is a better one to start off here. Okay, so what do we find? We find that Meta's undervalued, no doubt about it. Right. Meta's undervalued. It's trading way too cheap given the revenue growth in future years, right? And obviously net income growth they'll be having. Google, underowned, no doubt. 4P under 20 for Google, like double-digit growth company. Come on, man. Mr. Softy, 34 forward PE, double-digit grower, also undervalued. So I would say Meta, Google, Microsoft all are what I would call underowned. That's very fair, right? What about Apple, Amazon, and let's go Nvidia, right? Let's go these three. So Apple trading at a 30 forward PE with likely single-digit revenue growth. You could make an argument that Apple's maybe a little overowned, right? That man spent so much time talking about Apple alone. You could make a very strong argument that Apple's a little overowned, okay? Not massively, but like a little overowned. Amazon trading at a 33 forward PE, but with likely double-digit growth for many years to go in the future. I think you can make an argument that Amazon might be a little underowned. Nvidia 45 forward P seems really high compared to these stocks, right? But Nvidia also has insanely strong double-digit revenue growth, right? And EPS growth expected. Whenever that growth trend does break, Nvidia stock will break hard to the downside. But you can make actually an argument that Nvidia is underowned right now. And then the last one of the big mega cap techs would be good old Tesla, Tesla. That's one you could definitely make a strong argument that maybe is overowned there, right? But you could say that forever in regards to Tesla.
Trailing the benchmark or the index, what it would be. For example, NVIDIA, I think 7-8% right of the S&P. So
right.
Is there going to be catch up? And by the way, it's been very different this year. They haven't all performed similarly. I mean, you've got Microsoft and Meta and NVIDIA way outperforming the S&P, but then you've got Alphabet and Apple, which we just talked about, obviously, and Amazon underperforming.
Yeah. And so we've seen the degree of relative underweighting change throughout this year, which if you take that into account, you can kind of bifurcate between those that have outperformed and those that have performed in line or underperformed. But generally, all of the five mega cap tech names have been underweight this year. Meta has been the one exception. Meta has actually been overowned relative to its index weight for the majority of the last 4 years. Up until the second quarter, it is now underowned relative to its weighting, as it's had quite a nice run. And so we do need to kind of look at the starting point from the end of last year to where we are today. And using Apple again as an example, starting the year, Apple was the most underowned stock. It is now the third most underowned stock, as the stock has underperformed,
right?
But investors haven't necessarily cut their positions as much. And so that helps to explain the disparity. But the high level answer is, on average, mega cap tech is underowned by about 140 basis points exiting 2Q. Exiting 1Q, that under ownership was about 115 basis points. So we are more underowned than 3 months ago.
Right. And so perhaps there will be a return to making that more even.
So I'm going to have to run. I don't think we'll get to that last reaction video, but I could give my life-changing advice. Got to start carrying a water around, man. Like, I never knew about this, but it's a game changer. It's a life changer, man. You carry the water around, and it makes you feel different. Like, you feel like so much less stress. I got to say, I didn't think it was a real thing. I mean, I remember, like my dad, he never had any money in stocks, never had any money in savings, but he always had a wad. You got to have a wad. And I never understood it. I'm like, who cares, man? I got credit cards with unlimited limits and, all this stuff. Like, what do I need cash for? No, man, you need a wad. Like, I'm just telling you, you need it. You need it in your life. And listen, we're the last generation that can do this because, give it another 10, 20 years, the government's probably going to outlaw paying for cash with anything, or like carrying cash. Will be like, oh, it's used for illegal activities. You can't track it. It's illegal now, right? Yeah, I'm sure that's coming down the road. They're going to make us go all digital, right? All right, guys, appreciate you joining me. As always, thanks so much for being here. Pin comment down there. Get that free checklist. Send it over via email or via text. I think you guys will definitely enjoy that. Much love and have a great day.